Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. We have a lot to cover with you here this morning as markets are about to open up a little bit lower, especially if you're looking at the technology names. But the broader market is containing this move here to the downside. So we want to talk a little bit about what our expectations are here for the markets this particular week. I know last week was a challenging week for some, depending on what type of positions that you have and when your expirations or where your positions were concentrated in terms of expirations. So we do want to touch up on what caused a little bit about what caused that. For those of you that missed our take on Friday, make sure that you go back and review that because we did discuss at length as far as what drove some of the sell-off. Let's talk a little bit about what we expect here for this particular week. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So what we're going to do is we're going to start off by talking and having a discussion around risk on or risk off, meaning do we expect markets to continue to accelerate to the downside, or is this going to be fairly self-contained as we discussed on Friday? And then what we're going to do is we're going to take a look at the broader market update, the major markets, where we're currently sitting, with specifically some levels that I do think is worth paying attention to, especially on the technology side of things. How much downside do we still see to the, if we do get an acceleration to downside, what type of levels we want to pay attention to, because chances are the moves that we're going to see are going to be quick and violent. There may be intraday moves, so we want to make sure that we focus on those levels to pay attention to. We'll take a look at some of the economic data, how that's shifted the way the markets are responding to the economic data, because that I think is an important thing to note, not just the data itself, but how markets are responding to it. Take a look at some commodities because that has shifted some of the moves here in some of the individual sectors. And then we'll take a look at the broader sector review. We'll take a look at all the sectors, again, trying to paint this picture that the sell-off that we're currently seeing is fairly contained. And at the end, if we have a few minutes, we'll try to answer any questions regarding the markets. But the primary question that I want to help answer is one that we've got quite a bit over the weekend, which is the sell-off of the overextended markets that we've seen over the past couple of months? Is that over? Is there further downside? Let's take a look at some charts to help answer that question. So today, what I want to do is share with you my charts, the indicators that I'm paying attention to influence my views on the broader outlook of the markets, and the economic indicators that I'm paying attention to here in the markets. So with that, we're going to actually start off with one indicator that we've been talking about as a tool to gauge risk on, risk off. And that's a ratio of the VIX 3-month to the front month VIX. When we see that the front month VIX is higher than the 3-month VIX, this is telling us that markets are stressed and it's more of a risk off environment. Now, right now we're about to open up here. VIX front month is around 35.3, VIX 3 months is at 34.75. So the front month VIX is now above the VIX, which means that we're going to open up below 1 here. Now, we have seen intraday moves below 1 and then quickly move back up above that. We actually saw that on Friday morning. We saw VIX 3 months open up below that 1, but quickly recover back above 1. So that's one that we're going to pay attention to here. If we get a close below 1, that certainly puts, a more further downside pressure here on the S&P 500. Remember, the VIX here is on the S&P 500, not the Nasdaq 100 index, which is, something that we have to pay attention to, because before, the correlation between VIX and VXN, which is a Nasdaq 100 volatility index, was very, very high, but that has started to diverge a little bit. It still is very high, but not as high as it used to be. So what I want to do is I want to take a look at the Qs, which is the Nasdaq 100 index, and I want to take a look at how far we've pulled back and put into context as far as how far could it pull back. So what I have here is the fib levels from the March lows all the way up to the peak from last week. As you can see, the intraday moves from last Friday puts us roughly about 23% down from the peak, we've pulled back about 23% of the move from the March lows to the highs from last week. So intraday on Friday, we were just a bit shy of that 270 level here. So the levels that I'm paying attention to without the fib levels are the 250 and 270. The reason is because this is the level that the Nasdaq 100 spent a whole month consolidating in between these two levels, 250 and 270, before finally breaking out and moving on that very last extended move that it just gave back all of that here on Friday. Now, the fact that we got back below the 20-day moving average, intraday got back to the 20-day moving average, and now we're opening up below that, leads me to believe that there is some further downside, at least into this 250, 270 level. So targets to the downside, in my opinion, are extended to 250 to the downside and 270 to the upside. If we get to break below 250, then we're really putting into the 237, 238 level back from the February 2020 highs into potential levels here. So that corresponds with the 38 fib level and the 50 fib level for those of you that like fibs. Now, I'm not a big fan of fibs, but I do think that this puts us into gives us some context into how big of a pullback we're actually receiving here. And that pullback into this 38 to 50% zone, in my opinion, is a reasonable zone to target here to the downside if we do continue to see some acceleration to the downside. Now, because of what I spoke about last week, as far as what's driving the sell-off, a lot of market maker hedging, delta hedging here from market makers, that likely leads us to believe that any type of sell-off that we get is going to be quick and violent. This could happen over just a few trading sessions and get down into that 250, 240 zone, perhaps somewhere in that level, and see a quick move back to the upside after that. So that's my expectation here, is that we can see some further downside here, especially in the Qs. So I advocate that if you're going to try to buy the dip here, which I think many investors are trying to do in figuring out where to buy this dip, first of all, I think this 240, 250 zone is one that I would pay attention to here in terms of buying the dips. But if you're going to buy the dips, try to use limited risk strategies, because right now, even though at the moment this is fairly self-contained to the technology sector, and we look at the sectors, I'll show you why I believe that, and also the indicators that I showed you last Friday lead me to believe that this is self-contained. But that doesn't mean that it can't spill over to other sectors going forward if this does lead to a larger structural sell-off here. So right now it's being contained, but if you do take strategies to buy the dip, use limited risk strategies so that if you do get a further acceleration to the downside, you have limited risk. Chances are, especially when you're selling put credit spreads right now with the elevated implied volatility, you're able to collect a fair amount of premium. Most credit spreads that I'm looking at are collecting well into that 40% range in terms of percentage of the income to risk, which means that you're only risking about 1.5 to 1 on these buy the dip strategies. Those are the types of risk to reward ratios that you want to seek if you're trying to take advantage of the implied volatilities and sell strategies like put credit spreads. So use those strategies to your advantage, use the volatility to your advantage by limiting your risk as much as possible, by collecting as much income as possible. Now, when we look at the S&P 500, it's already gotten back to its February highs. So the Nasdaq 100 still about 11, 12% above its February highs. The S&P has already gotten here. So we're about to open up slightly below this 339 level. We've talked about this level as support. I do expect that we're likely going to shoot below that level before it can continue to level off here. So the question here is that 339 is back into view here on the S&P 500. We've been talking about this level for quite some time on the breakout. Now that we've gotten that breakout, we've come back to retest this level. I do expect a bit of an acceleration to the downside and overshoot this to the downside. Now the question is whether we're going to get further downside here. So we're going to pay attention to that VIX 3-month to VIX ratio and see if we can see an acceleration here to the downside and whether this is a larger structural move. But when we look at different segments in the market, when we look at small caps, we see this rotation into small caps. Small caps, after the Nasdaq and the S&P lost almost 10% last week, small caps only lost less than half of that, only about less than 5% last week. And we're opening up actually at the same level it closed on Friday. We're not seeing that on the S&P. We're not seeing that on the Nasdaq. So this is really one segment of the market that we're paying attention to again, give us the view that this sell-off is at this point contained to these high-flying stocks, specifically the FANG stocks that have just shown too much exuberance here over the past few weeks, removing some of that froth and seeing this rotation. So we've talked about how there's been no rotation at all, as that's very unhealthy with the markets. And now with the sell-off, we're seeing this rotation again. So this is the yo-yo that we're currently playing here with the markets here, is this lack of rotation back into rotation. And what we're going to do is we're going to look at not just the rotation of the broader market, but the individual sectors as well. So when we take a look at the equal weight indices, same thing. Now, this again shows us that it's just a few names that drag the markets higher that are now coming back to reality, because if you look at the equal weight indices, they have barely budged. The RSP, which is the equal weight S&P 500 index, after the S&P has declined almost 7–8%, this index has only seen about a 3.5–4% decline. So this is again further evidence that this is fairly self-contained. When we look at the fixed income markets, we did see a bit of flight to safety here on Friday. Not a big move here from the markets, and again, this is really telling us the fixed income markets are not seeing the same type of moves that we're seeing in the equity markets, which lead us again further to believe that this is fairly self-contained. When we look at the VXN, this is the SIBO Nasdaq 100 volatility index. The same way that the VIX is the volatility index for the S&P 500, the VXN is a volatility index for the Nasdaq 100. We are now back at 4-month highs. The high here from 48 puts us back into the coronavirus sell-off territory. So, you know, are the markets as uncertain now as they are from the coronavirus sell-off? I would argue not. So I think that when VXN gets above this $48 level, that's a better opportunity to sell volatility. So selling put credit spreads as these levels, as the volatility indices get to these extreme levels, those are opportunities, in my opinion, to sell, especially if you also believe that the directional view of this market is being contained to the Nasdaq 100 index. If you do feel that this is a broader structural sell-off, that this is just the beginning of a much, much larger sell-off, then I would not advocate that you sell volatility here. You're probably better off buying volatility, even though it's really expensive to buy some of those puts. But as we take a look at the sectors, I want to show you why I do believe that this is self-contained to that technology sector. Now, we did see some acceleration here to the downside. We've been talking about oil for the past couple of months of having zero moves, and we've seen this tighter and tighter coil. And now we've gotten this acceleration here to the downside here in oil. So this has some ramifications for energy, which is really the only sector seeing some moves to the downside with the exception of technology. So oil accelerating here to the downside is going to inform some of our views here on energy. On the flip side, when we're looking at commodities, you know, gold and silver has been fairly steady, as dollar hasn't really moved a whole lot here over the past couple of weeks, even though we started to see a little bit more of an acceleration to the downside, only to see that reverse as the Nasdaq 100 sold off last week. But copper continues to make new relative highs. Copper getting above the $3 level here. $3 being a fairly major level going back to 2017, 2018, providing a strong amount of support or resistance, finally breaking above that. So the fact that we've gotten a move here in copper leads us again to believe that the industrial demand, as we've seen in economic numbers, both in US and global industrial demand numbers, continue to surprise to the upside. Copper moving alongside with this confirms that move. So we're looking at some of the mining stocks, we're looking at some of the industrial stocks. These are some of the sectors that we do see will provide some further support as copper prices continue to move higher here. So this is going to, again, inform some of our directional views on the specific sectors. Now, the big number here was employment numbers on Friday. Initially, the markets responded very positively to the numbers, actually opening up positive on Friday morning before taking a big move to the downside and then reversing most of those losses here by the end of Friday, especially if you look at names like Apple some of the big names. So the question here is really looking at those numbers and what they actually look like if we take a little bit of a deeper dive. So we've had 4 back-to-back months of very strong job numbers: May, June, July, and August. All of these months came in better than expected in terms of economic surveys. And now, for quite a few months, we've been talking about that the markets were ahead of these economic numbers. They were telling us that they were looking forward. They were having a lot of optimism. Now that the economic numbers have come in actually stronger than expected, back-to-back, 4 back-to-back months of stronger economic data, what this is actually now leading us to is, again, markets kind of rethinking this in terms of, has the markets gotten a little ahead of itself? And the fact that economic numbers coming in stronger than expected so many times back to back, does that now put less downside, more pressure in terms of for Congress to pass a second stimulus bill? Arguably, that the stronger the numbers look, the less onus the less pressure that Congress would have to pass the second stimulus bill. Now, arguably, the markets have been pricing in this second stimulus bill as almost a certainty. Now that we've had these economic numbers come in stronger than expected, we're starting to hear some rhetoric from the government that, this puts less pressure on passing a really big fiscal policy. Big fiscal policy, that the second unemployment stimulus bill is likely going to be smaller than we expect. And this is putting some downside pressure here in the markets. And that is another thing that we have to pay attention to now, is that markets are now paying attention to the fact that we have strong economic numbers and potentially actually taking that as bad news. So this is one shift that we're starting to see here in the markets, because it's one thing to look at the numbers itself. It's a whole other thing to look at how markets are reacting to it. And we're starting to see a little bit of a shift here in how markets are reacting to it. And this is one that we're going to pay attention to here over the next couple of weeks, because employment numbers, very, very important for the markets, but markets are starting to view it in a slightly different way. We also see a very big diverse bifurcation here in terms of how the employment numbers and how economic recovery is looking depending on your income levels. And we're starting to see this K-shaped recovery, meaning for one segment of the market, the higher income segment of the market, we're seeing more of a V-shaped recovery. And then when we look at the lower income markets, we're seeing more of a W-shaped recovery. And this is referring to that K-shaped recovery where you have a diverging path depending on what your income levels are. So if you look at some of the household income loss, we're seeing that the lower your income levels are, the higher your income loss actually has been since March 13th. This is that K-shaped recovery. Now, this is just one indicator. There are plenty of other indicators that we can take a look at depending on income level as to what your what the economic impact looks like. And we're starting to see this bifurcation further and further. So this is what's, causing this bifurcation in the market that is a theme that we've seen since the beginning of COVID, is that you have this bifurcation in terms of sectors. You have strong sectors like technology and discretionary continuing to take off. You have weaker sectors like financials and energy continuing to decline. And this bifurcation, we're seeing this across the board. We're seeing it within sectors. We're seeing it in the broader market. We're seeing it in economic indicators. This is going to be a theme that it's going to play out here, not just for the next few months, but likely for the next few years as far as haves and have-nots. So this is really one where we do see, if you're paying attention to the markets, the opportunities are coming from this bifurcation that we're seeing. And this is not good for the overall economy when you see this bifurcation, when you see lower income being kept further and further behind, while higher income groups getting further and further ahead. This is going to cause some problems, but in the short term, this is one that we think does have some opportunities here. When we look at the economic recovery here, when we look at high frequency data, we are continuing to see improvements here on this front. This continues to confirm that the equity markets are forward-looking and seeing this optimism here. It's confirming those. It's not as strong as the equity markets are pointing it to, because we have seen some growth here over the past couple of weeks as COVID-19 cases have dropped, but the overall recovery shape has been fairly flat here for the past 2 months or so. We're starting to see a little bit of an acceleration here to the upside. We have more good news here over the weekend from COVID-19 numbers continuing to decline here. Economic recovery trackers from both mobility, economic recovery, as well as retail sales starting to uptick a little bit further here as COVID-19 cases continue to decline. So this is really where the equity markets are trying to find a nice balance here between getting a little overextended, coming back to reality, and trying to move forward going forward. But overall, the economic numbers looking relatively strong, looking positive at the very least. And again, that's part of why I don't think this is the start of a larger structural sell-off here in the markets. So to answer the question of the individual sectors, we have to look at all 11 sectors, see where they're currently trading, especially pre-market here this morning, gives us a lot of insights into how the markets are reacting to this. So by far the biggest loser, technology. You know, like I said, the price action here, you really have to look at more intraday charts to get a better sense for what's happening here, because it's happening over such a short amount of time. But what we had is basically over a 3-day period, we had a roughly 10% decline in the Nasdaq 100 index. It came back to retest the 20-day moving average as of Friday's close. And as of this morning, we're now opening up lower from that level. And that's why my directional view here for the technology sector is further downside. Now, I prefer looking at the Qs for some of these levels here, but you have some of the similar levels here for XLK, 104, 110. Those are my targets here to the downside for XLK. I do think that you can get there very quickly, perhaps by Wednesday or Thursday, get into that level. Those are the levels that I would pay attention to see some buyers start to step in here. But I do think over the next two trading periods, you're likely to see some further weaker players get squeezed out of the markets here. You know, whether you're long options or long stocks, from this perspective, you're likely going to get squeezed out on a move that gets into that 104, 110 area. Once those players get squeezed out, that's when you could potentially start seeing buyers start stepping back in. When we look at XLE, this is really one where, you know, XLE has been a large underperforming here for many, many years. And we had what looked like a decent recovery after coronavirus sell-off. For a short period of time, energy was the best performing sector in the S&P 500. But since then, we've seen multiple moves down to that $34, $35 level. And each time it gets down there, you've had smaller and smaller moves to the upside. So this is really where I see oil rolling over, breaking below this level and getting back into the 30s and potentially even high 20s here. So oil continue to break to the downside is going to put downside pressure here for energy. I think that is the catalyst that it needs to break below that $34 level and see some further moves to the downside here. When we look at healthcare, this is one that has been holding up relatively strong. It hasn't had the same level of exuberance here over the past few weeks because XLV actually broke above its February highs back here in early July. But it has made no progress since there while the markets has continued to move higher. So this is a sector that has underperformed. And now as the market sold off, this is a sector that is now starting to slowly outperform. And it's still sitting above that 104 support level, and this is really a level that I see as a potential support for further upside here for XLV as we see this rotation out of technology, potentially out of discretionary and some of the other high-flying sectors into some of the sectors that have fundamentally a lot of strength but hasn't seen some of the gains here to the upside. Healthcare, one of the sectors that I certainly see as a net beneficiary of this sell-off here as we see this rotation. So that the lack of sector rotation that we've been talking about here for the past 3 to 4 weeks or so, starting to see that come back to life. Granted, it's coming back in a fashion that's not typical. You know, we don't want to see these types of violent 10% sell-offs here in one sector and then seeing rotations into other sectors and then violent rotations. Again, that's not the type of market that's healthy to trade, and it's difficult to trade, more importantly. So this is one that we're not particularly fond of, but at the end of the day, we are seeing the sector rotation that we were lacking for the last 3 to 4 weeks. That is the type of rotation that you need to see for a market to get back into that healthy state, if you will, that we've kind of decoupled away from for the past few weeks. When we look at XLU, this is arguably one of the sectors that should see some gains here as we see further pickup in volatility, as rates continue to decline here to the downside. Utilities, one of the higher dividend paying sectors. Not a lot of volatility here, which certainly is generally good for when you're looking for protection, you're looking for yield, you're looking for defense, and XLU providing both of those. Protection from sell-offs, as you can see, utilities not selling off of the broader market, provides a lot of yield, providing a little bit more downside protection. So this is one that we do think we could see a breakout here to the upside as we see some rotation out of technology. When we look at staples, this is again one of the strongest sectors. Similar to that healthcare play, managed to get back above the February highs, but only did so recently here and sitting above that support level. So I do see that we could see potentially a move here, potentially further here to the upside for staples as we get, again, rotation out of technology, the higher beta sectors into the lower beta sectors. When we look at discretionary, this is one where I do see there's further downside here because as you can see, discretionary is still far above the February highs from 2020. So discretionary, similar type price action, had the break below the 20-day moving average, came back to retest this and is about to open up a little bit below that. So we do see further downside here into this 132 area for XLY. Especially if you look at the constituents of XLY. You have Amazon, which obviously is taking a bit of a dip here along with the technology rally, but you also have some of the home builders. We saw lumber prices come down last week. We saw some of the home builders starting to come down here. So some of the exuberance in the housing sector also starting to pull back a little bit here. So XLY here under some pressure in my opinion. XLF, this is really where we see some coiled potential here. It is still below that 200-day moving average. So until you get that breakout above that 200-day moving average, it is not quite ready to play for that upside. That's why our daily play here for today is XLF, but using a diagonal because we could see this trade sideways and maybe even a little bit lower here over the past next couple of weeks before you do get a potential breakout here to the upside. I don't think you're going to get a breakout in XLF until you see this technology sell-off being a little bit more contained. So that's why we think the diagonal trade that Mike set up here on CNBC on Friday's options action is the way to play for this kind of wait and see type of game, is using diagonals here for this type of market environment. Real estate is also one of the sectors similar to utilities where we see some protection, we see some defense, we see high yield, but real estate is obviously one of the sectors that is more affected by coronavirus. So this is one that we do see more limited upside. So between utilities and real estate, if you're looking for yield, our preference is utilities over real estate. We're starting to see some cracks form in some of the REITs, especially ones that have more exposure to urban areas, some of the urban living spaces like Avalon Bay. We're starting to see some weakness in some of those names. So real estate, I think upside here is fairly limited despite the fact that it provides protection and provides a fair amount of yield. And lastly, Xlc Communications. This is also one that has limited names in that FANG category, if you will, but Netflix obviously is one of the names here. So we do see a little bit more downside here for communications, not a whole lot because defensively, this is a sector that is relatively strong. The broader names here is not part of the FANG sector. You have a lot of broadband names, you have a lot of telecom names that are going to actually be supportive of this. So while I see a little bit of downside here for communications, not a whole lot here, certainly not to the same extent that we see in discretionary and technology. And lastly, actually we do have a few more. Industrials actually taking off here with the broader market here. So we do like industrials as a sector. It still has quite a bit of room to grow here to the upside before that get back to that February 2020 high. However, again, along with the markets under this downside pressure, I do think that this is the type of play that you want to wait a little bit, wait for a little bit more stabilization in the technology names before you see this further rotation into XLI. We are starting to see the rotation, but on the relative level, on a relative basis, but I think to see the move here to the upside on an absolute basis, you're going to have to wait for this rotation out of tech to kind of flesh out a little over the next few trading periods. Same thing here for materials. We talked about materials as kind of get back to that all-time high here. Looks like it's about to break out here to the upside. And again, we're seeing this sector beat on a relative basis. Again, to wait for the breakout here on an absolute basis, I would wait for that breakout here on the market. So with that, I want to thank everyone for taking the time out here this morning. I know we went over a whole lot of things, and there's a lot of movement here in the markets. The market's just about to open. I know many of you want to go and pay attention to your portfolio. Looks like the Qs are opening around 271. The 3-month VIX is currently trading at 35.4. So the VIX is now below, the VIX 3-month to VIX is now below 1. Let's see if this holds, because we have seen some intraday moves below that level and come right back above. I would like to see a close below 1 in order for me to be on a risk-off view here on the broader markets. I think, again, based on everything I showed you here, I do think that the risk-off here is contained here to technology. But again, we want to pay attention to that because it could spill over to other markets. It hasn't yet, but we're going to keep you aware of what's currently happening. So thank you so much. I hope that you guys have a great trading day. I will share with you the recording here to make sure that you guys have access to this after the fact. So please have a great day, and I'll see you guys here on Thursday.